you're still on Dually Exchange, let's begin our conversation in this regard by looking at some of the monetary policies and the decisions taken by the CBN in recent times, just as the World Bank has released its latest report indicating that the CBN monetary policy tightening template might not tackle the issue of inflation as anticipated. Now, if this report is something to go by, what will be the implication of these for the Nigerian economy? And what should be done to ensure that, as anticipated, the inflation by the end of the year will be managed as regards these decisions made by the CBN? This will be the thrust of our conversation. Let's begin our business of shaping policy in this regard by bringing in our guest analysts. We're being joined by Orji Chigozie Udemezue, who is also the managing consultant, CEO Flame Academy and Consulting Limited. Orji, glad to have you join us this morning on Early Exchange. Let me bring in Blessing. The decision by, you're aware of the decision being made by the Central Bank of Nigeria at the last MPC meeting, where it decided to, in its wisdom, decided to increase the MPR to 26.2%. And now the essence of doing that is to see how to manage inflation, which according to the central bank governor, the press release that was done. Now, but what the World Bank is saying now, given its economic outlook for the rest of the year, 2024 till 2025, we're in the last 6 months of the year. Now, what the report is stating that the CBN monetary policy tightening, template might not in any way manage inflation as anticipated, or might not be the only thing to have been done to ensure that you manage the inflation. Compared to what is happening in Europe, if you study the trends in Europe and other large economies, you know that as a result of tightening of the economy, the inflation is getting lower figures and the statistics being released. But like what is happening in Nigeria, the inflation, is skyrocketing, looking at food inflation and the result. Now, if this is something to go by, it's going to make some impact on the economy of Nigeria, and that's why it's important for us to have this conversation to see what can be done. Our regard, our obligation is to shape policy to see what can be done to ensure that if this report is something to go by, something can be done. And when the World Bank is saying something or releasing a report like this, it's something that is meant to be taken with all sense of seriousness. What do you think?
Well, when the IMF says that the institution doesn't think that monetary tightening will help Nigeria's inflation, well, I think the CBN should listen, because the CBN has for a while now seemed to be listening to the IMF and the World Bank, because at some point the same IMF were suggesting that Nigeria increases or tightening monetary policy. But now that having tightened monetary policy twice, and it hasn't produced desired results, I think, yes, it's high time that the CBN take a different approach, because from March, it was around 24%, 24.75%. That was the MPR after the last Monetary Policy Committee meeting. And then in May, when the CBN had the last MPC meeting, it was increased to 26.25%, which is quite high for that to be the lending rate to the commercial banks, because they too will add their own margin to it, profit margin to it, before lending to businesses. So I think why it's not working in the case of Nigeria, because you mentioned that in other parts of the world, they've tightened monetary policy and it has worked for them, because the cost of the inflation in these areas are different. So it's not a one-size-fits-all. If you go that route, you might get it wrong. But hey, we have a guest joining us this morning, and let's hear from our guest this morning. Thank you for joining us, Udemezue. Glad to have you in Early Exchange. The IMF has a different position from what the Central Bank of Nigeria has regarding monetary policy. So the IMF thinks that tightening monetary policy for Nigeria may not help actually in reducing inflation as anticipated by analysts. What's your take on it?
I was suggesting that the central bank would now have to listen to the Bretton Woods institutions, IMF and World Bank, if they cannot listen to small voices like us. But what they are saying is not completely strange. There are things we have said, even on your own television, that the tightening of monetary policy cannot solve Nigeria's inflation the way you expect it to solve it in Europe or in America. And I can break it down if I have enough time here to do that. Nigeria is not an economy driven so much by credit, driven so much by lending, driven so much by ease of access to fund when there is too much money in the economy. Usually, theoretically, inflation is interpreted as when there's too much money, pursuing few goods in the economy or in the market. Therefore, it's assumed that when there's so much money in circulation, prices go up, and then that causes inflation. And therefore, the usual or typical monetary policy that is geared towards reining in inflation is to make money scarcer in the economy, to control money supply, which is the focus of monetary policy. How do you make money scarce in the economy? You increase interest rate. When you do that, a number of things will happen. Two most important things that will happen to control inflation is that when you increase interest rate, then bank lending, banks giving money to people to build houses, do business, and so on. Bank lending, even consumer lending, and so on. People that want to buy television, buy domestic things, and so on. Bank lending will become more difficult and tighter and scarce, making money supply limited in the economy. And two, by the time interest rates go up, like the monetary policy rate, which is the benchmark interest rate in the economy, when it goes up, people will tend to invest their money more in different money market instruments than spend in supermarkets or in shops. And therefore, these two very important effects will curtail price increases. That's to manage inflation. It works in the US. It works in Europe. It works in most developed economies where fund availability is always driven by interest rates. And therefore, by tweaking or manipulating interest rates, you can curtail inflation. But in Nigeria, it's a different ball game altogether. And I can explain if you give me some time. Nigeria's inflation is not driven basically by fund availability in the market. Yeah, even when they cry that there is too much money in the economy, that too much money is not reflected in the hands of the ordinary economic agents in Nigeria. Employees who have got salary increases, job market or job showing or job rates, which is going up. More and more people are getting employed. They have money in their pockets and so on. When you hear that in Nigeria there's so much money in circulation, usually it does not reflect in the pockets of the ordinary Nigerians. The unemployment rate in Nigeria is so high right now. People are getting poorer. Even the inflation itself is eating up the people's command over commodity. That's what you call purchasing power. So Nigeria's inflation is clearly not caused by all of us having too much money in our pockets or banks giving much more loans, as it were. Nigeria inflation is basically caused by the increase in prices of input materials and, of course, even finished products. How do I mean by this? Nigeria is an economy that imports nearly everything that we consume. Even the things that we produce in Nigeria, we still import raw materials to be able to produce them. And you find that, because we have to import everything, both the raw materials and finished goods, we need dollars to bring these things in. And because our dollar earnings from our export transactions is never enough to satisfy our import, the power of the naira keeps weakening against the dollar. And you find that we always now need much more naira every other time to be able to get dollar to import. So the devaluing or the depreciation of our naira continues to be the major cause of our inflation. So the volatility in the exchange market has to be solved in more ways than what central bank is doing right now. Maybe I can pause at this point, and then I can continue if you give me a chance.
All right, interesting. Now let's revisit the decision made by the CBN at the last MPC meeting, where in its wisdom it decided to increase the MPR to 26.2%. Now the essence of doing that was to find a way to contain or manage the inflation. I want you to talk to us. What do you think has been the impact of these in the last few months, ever since this decision has been made, a few months after this decision was made? Has there been any impact, or it's too early to see result from this?
Now, looking at the first action by central bank around March this year, where the rate was jacked up from a previous level that was actually decided sometime in 2023. So the 6 months gap when the central bank under MFL could not meet in the MPC meeting, now they had to jack up the rates with multiples of basis points. Like we saw the monetary policy rate moving from around 18 or 17% to 22.5 then, before it was further moved to 24 and then 26 now. So since then, if you look at the lag time, normally you can give a lag period. Normally when you make a policy, you give a lag time before you can now say whether the policy is working or not. Looking at the key indicators, the food basket, monthly inflation data and all of that, the price of food in a particular basket, the consumer price index, and so on. If you look at that, you find that since March, when the tightening started, we haven't had any significant impact to show that this policy is working in Nigeria. Inflation was around 33% then. It is still 33% today. And might even get worse with the Naira not showing up very well in the market. Naira is not still doing well. All right? So you can clearly say that the policy is not making reasonable impact as expected. It's not making reasonable impact. And, even if you look at the 3 months lag time, by now we should have inflation trending at below 30%, but that has not happened. So in summary, I can confidently say that even if the policy is going to work, it cannot work alone. You must combine other important strategic decisions, which I can also suggest here, if time allows, to help bring inflation down. That's what IMF is saying, that we cannot depend only on this same strategy, which does not work for our country, because our economic dynamics are not the same as you find in Europe or America and other well-established and well-run economies.
What could help to rein in inflation in Nigeria? What are some recommendations you'd like to make? Because food inflation is even higher. It's around 40.66% as of May 2024, and inflation still stands inflation rate as at May also was 3.95%. Now we're waiting for the NBS to release that of June for us to know what the current rate would be. But haven't tried tightening monetary policy and it didn't work, what should be the next step?
Okay, in Nigeria, the food inflation element of the main inflation figures, that is the what was the term again? That's the main forgive me, I will mention that shortly. So the food inflation element of the global total inflation component is very, very significant. I mean the headline inflation. When you bring in all the components, you find that the food component is very, very high. It's a big issue in Nigeria. And that should not be, because even though we import food, it's one area we can easily apply import substitution and produce our own food. But why are we not producing our own food or making that food go around the country so that, the inflationary trend will come down? You look at the issue of insecurity. Till today, despite all the promises we've got from our leaders, banditry is still very prevalent in most parts of the north. Kidnapping is very, very, disturbing. Herdsmen attack and all of that is still predominant even in the key food baskets of the country. In Kogi or Taraba, all the areas in the northeast, northwest, north central. So farming business or farm business is no more going on as it used to. Farmers are being waylaid or, waylaid in their farms, are being killed. And that is slowing down farming activities. Then the next major issue in the food basket or in the food inflation element is movement of these commodities. it's getting more and more difficult to transport food and agricultural produce from one part of the country to the other. One is the issue of fuel cost, energy cost in movement of this food. Two is all kinds of logistics bottlenecks, all kinds of charges and tariffs and road travel complications. I mentioned that earlier, that to move food in Nigeria from one location to another is very, very expensive.
The conversation is still about the state of the Nigerian economy, as the Brentwood institutions have made projections for Nigeria's real GDP growth for the year 2024, and it's around 3.3% to 3.5% from the IMF to the World Bank projection. And we have Orji Chigozie, who's a guest joining us virtually, talking with us on the issue. Now, getting back to the conversation, one of the factors that also lead to increase in inflation rate in Nigeria is the depreciation of the naira. And over time, the CBN has tried some approach to ensure that the naira gains significantly against the dollar. We saw that happen for about a month, but it didn't last long before the naira again depreciated to the dollar. In that regard, understanding that Nigeria is highly import dependent, what can be done to strengthen the naira?
Needs to begin to pay serious attention, not just lip service, to non-oil export, expansion. Nigeria cannot afford to continue to have more than 80 or 90% of its export earnings coming from the crude oil. Meanwhile, the oil and gas sector contributes only about 10% of our total GDP. So it means that the economy is not efficient. How can a sector that gives us only 10% of our GDP composition be giving us more than 80% of our FX earnings? It means that several other sectors, solid minerals, agricultural activity, tourism, financial services, and education and so on, are not paying their own dues in helping us raise the scarce FX resources that we need badly in this country. It means that we're only exporting oil and we're importing nearly everything else. We can't continue that way. Government, through the fiscal authorities, must support the central bank in finding ways to ramp up our US dollar and other foreign currencies earnings through exports to India, to China, to Americas, to Europe, and so on. That must be ramped up quickly. That's even though it's not an immediate solution to our FX challenges, but it must be taken seriously so that in the medium to long term, we can have more sources of FX inflow. But on the immediate term, the central bank has very commendably been able to bridge the gap between the foreign exchange rate in the official window and the foreign exchange rate in the parallel market window. That is quite commendable. How can they now use that policy to ramp up FX liquidity or inflow to reduce this pressure on Naira right now? I suggest sincerely that, having achieved this close-up in the rates and therefore curbing, curbing round-tripping, the next most important thing to do is to open up all the avenues and windows for FX inflow, both through the foreign portfolio windows and foreign direct windows. Foreign direct is a bit more complex because our insecurity keeps scaring people away, but then we have to find a way to market Nigeria to the world to bring in direct investors. On the portfolio side, we had raked in a lot of millions of dollars earlier in the year, but the problem with portfolio investment is that it is volatile. It comes in today, it might leave the next day again. So while you celebrate that you have plenty of dollars coming in from portfolio investors, the next month you may be grappling with how to raise dollars to pay them back their money so they can return to their country. Portfolio investors do not stay. They come to earn your high interest on your market instruments and then exit as quickly as they can. So how do we open up the FX inflow? I keep saying that central bank cannot continue to force exporters, people who suffer to go to the farm and everywhere else to gather things and export, and then you force them to surrender their money to you, on your own window. Allow the exporters to sell their US dollar or pounds or euro whenever they get them, in any market they choose. Make that reform complete. When people that bring in dollar can sell it to the market they want, dollar availability will be ramped up, because when you regulate what they can sell and what they cannot sell, many of them end up flowing the dollar away and it will never come back. They understate their export and minimize the amount of dollar they bring in here because they are not expected to make much on it. That policy must be done in the immediate. As I speak, they must be thinking about doing that. When they do that, the FX volume will increase clearly. And then they can curtail for IOCs, like international oil companies and other government-related agencies, they can still curtail how they sell for transparency purpose. But for every private entity, whether in oil and gas or other sectors, you should allow exporters to sell their dollar in any market they choose. That way, you will boost export. By the way, countries like Japan, to encourage export, had continued to, hold their currency not to appreciate against the dollar. In fact, sometimes in the past, they deliberately devalued the Japanese yen to boost export. And when you are doing that, you're making more people to drop the 9-to-5 job and enter the farms, enter the bushes, find anything they can find to produce and export. Even now with AFTA, where we can have intra-Africa export and so on boosted, this is a policy we must drive now to boost export and increase our dollar inflow. So we must do that now. And following that, you must regulate the IMTO window to enable more people bringing their dollar. Diaspora inflows, and other sources.
All right. Let me bring in the next line of conversation. Having, done a review of the decision that was made by the CBN in the last MPC meeting, let's look at the impact of this decision on the business community, business owners in Nigeria who have not been able to access capital finance due to the fact that the interest rate is high. What do you think will be the way out of this challenge, and what will be your recommendations in this regard? Let me get back to that question so that you can have a proper view of what I would like you to react to now. Let's look at the impact of the decision that was made by the CBN on the business community, business owners in Nigeria who have not been able to access capital due to the fact that the interest rate is high. What are your recommendations in this regard? How can this address this kind of challenge? You agree with me that when it comes to financing, it's critical when it comes to business operations.
The complaints I've laid on most programs I've run on your platform and other television platforms. When we go aggressive in trying to rein in inflation the way we are doing right now, hiking rates, because when you talk about the monetary policy rate, you forget the more crucial policy that affects lending, which is the CRR, which is now jacked up to 45%. What does that mean? For every 100 naira a customer gives to a bank, the bank must lock up 45% in the central bank, in the cash reserve requirement policy of the central bank, leaving behind only 55 naira out of that 100 naira. And the bank must again keep 30 naira out of that in their liquidity policy, LRR, which is hardly talked about, in programs like this. Banks are required to keep 30% of customers' deposits in liquid form. What does that now mean? That for every 100 naira you give to a bank, they must keep 45 naira in central bank and keep 30 naira in liquid form, in cash and other near cash instruments, leaving them with only 25 naira to lend. And if they must lend that 25 naira to make enough profit to pay the customer interest on the 100 naira, that interest rate on that loan must be crazy. That's why today in Nigeria, people borrow at 40% in the formal banking sector. Informal sector is much, much crazier. In the street, you get loan at 10% flat per month, which is like 120% per annum. So you cannot grow your economy, the productive sector of the economy, with that kind of policy. To borrow now to run a business, you must be doing something crazy. Whether you are doing something like gambling or so. Otherwise, manufacturers in Nigeria are going down and down. Nigeria's manufacturers are going down and down because they can't borrow at that rate and make profit. So, and that is a very major disincentive for Nigeria's, economic growth. Growth is being sacrificed at the altar of inflation management.
All right. So when growth now is being threatened, what more can be done in terms of economic policy? It may not be within the control of the central bank to handle some things, but at the government level, what can the economic team do to salvage the situation?
Okay, I've given the template already. If we're able to curtail this FX liquidity problem, then we will now stop hiking, because once FX is available, even central bank will find that interest rate jack-up is not solution to our inflation. And then we will stop using that lever, that's the monetary policy levers, to curtail inflation. When we do that, interest rates will come down. Rates will come down. And when rates come down, obviously, capital will be available to businesses, and then you begin to see economic growth ramped up. I don't know if you're getting me here.
All right, let me do a follow-up to that. You know, we're heading towards the last 6 months of the year, and the World Bank has projected that the economic growth in Nigeria will be at 3.3% and around 3.5% by 2025. Do you think this projection is something to go by? And then what do you make of this argument that the World Bank or IMF dictating our template as far as Nigeria economy is concerned?
They don't dictate template for you. They use the data they have to estimate what they think your inflation might grow to. You can do better than that. You can do less than that. It's left for us to run our economy efficiently with the right policies to beat whatever they estimate. But even at 3.5 or even 4% or 5%, it's still shameful. This is an economy that had averaged 6% and more in the past, and an economy that aspires to be a $1 trillion economy in the next 6 years or so. So a growth of 3.5 or even 4% is abysmal. It's not enough to get us to where we're going to. So World Bank or IMF or whatever projections that we have, it will not matter if you can come home and tweak policies that will enable our economy grow, and not policies that will, further, shrink our economic growth.
We started a conversation. You made mention of the CBN listening to the Bretton Woods Institution. Now, you said you didn't listen to local analysts. Perhaps they would listen to the suggestions of the Bretton Woods institutions. But let's bring that in. What is the issue here? What do you think is the issue when institutions like the Lagos Chamber of Commerce and Industry makes recommendation, when economic analysts locally make recommendations and they seem not to get the attention except when these recommendations come from foreign bodies or foreign institutions? What's your take on that?
Well, we have lived with that for almost all our life, where we don't appreciate local content. In anything we're looking for foreign education, foreign groundnut, foreign oil. Everything is foreign. Even our own crude oil, we have to send it abroad to refine and then use locally. So we don't appreciate what we have. We have enough professors of economics. We have enough consultants who can apply local factors and situations to profess evidence-based policy recommendations to central bank. But as usual, we will prefer to hear from Bloomberg or from IMF, who sometimes don't understand the local idiosyncrasies in our economy. When they give us recommendations. It has taken IMF, I don't know how long now, to find that this policy will not work. But we know that. We know our economy. We know how economy is structured. Economic structuring is very important. If you know the structure of the economy, you on your own can provide solutions to your problems. You don't have to wait for IMF to give you directive from US or Luxembourg or anywhere for you to solve your economic challenges. All right. So, in economics, you call that a foreign demonstration effect, where people always prefer goods and services that are foreign to their own local products. It's a major issue in Africa. We don't buy Africa. We don't sell Africa. we're looking for foreign things, all the time. So the central bank had better, calm down their high horses and find a good team, of, economists. We have enough professors in our various universities, and we have people who are also exposed in their endeavors to be able to look at this economy and monitor the evidences that will give us a better policy to run this economy. That's my view.
All right, Orji, without preempting, the outcome of the next MPC meeting, do you expect the CBN to further tighten the economy or its monetary policy, given this advisory from the World Bank and also the impact we've had in the last few months? What would you expect in the next MPR meeting, some of the MPC meetings rather, and some of the critical decisions you will be expecting the CBN to take in that meeting, given the outlook that is being projected by the World Bank for the rest of the year?
Okay, at the risk of sounding harsh, I think it will be quite crazy and unthinkable for the central bank, having seen the evidence we have seen in the past few months, to go ahead and tighten policy anymore. It will be a crazy decision to make. So I don't expect any further monetary tightening. Otherwise somebody is actually poisoning our economy or killing the economy by themselves, thinking they're helping the economy. We have got to that, and I said it here on other platforms some months ago, that when the central bank gets to their monetary policy exhaustion level, that we will come back and taunt them. Nobody likes to mock this economy. We want Nigeria to succeed. Nigeria belongs to all of us. But it's crazy when you find people who keep applying textbook and theoretical solution to a problem that they know, is not going to respond to theoretical policies. So any further tightening will be a deliberate attempt to kill this economy. I don't expect that tightening. The best they can do for now is to hold the policy where it is. If they cannot soften the policy, they should at least hold it and watch a few more months. Maybe through this, we've just entered the third quarter today, July, August, September, to hold the policy and watch the next 1 or 2 months and see whether there will be any impact of evidence to show that, it is now okay to begin to lose it. Around the world now, some central banks are beginning to plan to cut rates. Even the U.S. Federal Reserve, we expect that before the end of the year, depending on the outcome of the upcoming election, rate cutting might begin to happen. Somewhere in Europe, Spain, and a few other places, rate cutting has already begun to, happen. So Nigeria may not need to tighten any further. What they might do is to watch, hold the rate for another 1 or 2 months. But left for me, I think they should loosen the rate, drop the rates a bit, in their next meeting, calm the rates down and focus more on medium to long-term approach to make dollar liquidity better in this economy and create a more stable US dollar Naira exchange. That is, for me, what will give us the solution we are looking for. Tightening is not working, as now confirmed by the IMF.
Thanks, Orji Udemezue, the managing consultant and CEO, Flame Academy and Consulting Limited, who's been our analyst on this segment of the show. Thank you for your time.
Thanks so much for having me. Blessing and Femi, I appreciate you. Thank you.
Exchange, shaping policy, advancing development.